Good day, everyone. Now we are on the part 2 of our discussion in interim financial reporting, and this is the continuation of our discussion. Let's proceed. Basic principles of interim reporting. PAS 34 paragraph 28 provides that an entity shall apply the same accounting policies in the interim financial statement as are applied in the annual financial statements. However, the frequency of an entity's reporting, whether annual, half-yearly, or quarterly, shall not affect the measurement of the annual results. Therefore, measurements for interim reporting purposes shall be made on a year-to-date basis. Revenues from products sold or services rendered are generally recognized for interim reports on the same basis as for the annual period. Costs and expenses are recognized as incurred in an interim period. Expenses associated directly with revenue are matched against revenue in those interim periods in which the related revenue is recognized. Expenses not associated directly with revenue are recognized in the interim period as it is incurred or allocated over the interim period's benefited. So, if the expenses are associated directly, it shall be matched against the revenue in the interim period in which the revenue is recognized. However, if the expenses are not associated directly, it should be recognized as incurred or divided over the interim periods it benefits. PAS 34 paragraph 21 provides that if the business is seasonal, in addition to the current interim period financial statements, the entity is encouraged to disclose financial information for the latest 12 months and comparative information for the prior comparable 12-month period. So the entity is only encouraged to disclose those information, but they are not mandated by PAS 34 to do so. Paragraph 41 provides that the preparation of interim financial reports generally requires a greater use of estimation than annual financial reports. It is because there are a number of interim reports made during the year than annual financial reports which is made once a year only. Now let's proceed to inventories. Paragraph 25 of Appendix B of PAS 34 provides that inventories are measured for interim financial reporting by the same principles as at financial year end. Thus, simply means that inventories shall be measured at the lower of cost or net realizable value even for interim purposes. The cost of the inventory may be estimated using the gross profit method or retail inventory method. Full inventory and valuation procedures are not required for inventories at the interim dates. Accordingly, if the net realizable value is lower than cost, a loss on inventory write-down shall be recognized regardless of whether the write-down is temporary or non-temporary. PAS 34, paragraph 17 requires disclosure of the write-down of inventories to net realizable value and the reversal of such write-down in the later interim period. The net realizable value of inventories is determined by reference to selling prices or the market prices and the related cost to complete and dispose at interim dates. Seasonal, cyclical, or occasional revenue shall not be anticipated or deferred as of an interim date if anticipation or deferral will not be appropriate at the end of the entity's reporting period. So it shall not be anticipated unless anticipation and deferral is appropriate. Thus, dividend revenue, royalties, and government grants shall be recognized in the interim period when they occur. For example, dividend revenue is not recognized until declared because even when highly predictable, based on past experience, the dividend is not an obligation of the entity until it is legally declared. Now, uneven cost. Costs that are incurred unevenly during an entity's financial year shall be anticipated or deferred for interim purposes only if it is also appropriate to anticipate or defer that type of cost at the end of the financial year. For example, a provision for warranty is recognized at interim date because the entity has no realistic alternative but to make a transfer of economic benefit as a result of an event that has created a legal or constructive obligation. However, The cost of a planned major periodic maintenance or overhaul that is expected to occur later in the year is not anticipated for interim purposes unless an event has caused the entity to have a legal or constructive obligation. Expenditure for advertising is not deferred but recognized as expense in the interim period it is incurred, because it is not appropriate to defer such costs at year-end. Year-end bonuses. The nature of year-end bonuses varies widely. Some are earned simply by continued employment during a time period. Some bonuses are earned based on a monthly, quarterly, or annual measure of performance. And some bonuses may be purely discretionary, contractual, or based on years of historical precedent. A bonus is anticipated for interim purposes if, and only if, the bonus is a legal obligation or past practice would make the bonus a constructive obligation for which the entity has no realistic alternative but to make the payment, and a reliable estimate of the obligation can be made. Irregular costs. Certain costs are expected to be incurred irregularly during the financial year, such as charitable contribution and employee training. Such costs are generally discretionary, and even though they are planned, shall not be anticipated as of an interim date simply because the costs have not yet been incurred. Depreciation and amortization. Depreciation and amortization for an interim period shall be based only on assets owned during that interim period. Asset acquisition or dispositions planned for later in the financial year shall not be taken into account. So, the depreciation and amortization that the NTP should record for interim period should only be based on the asset it already owned during that period, and not asset which it purports to buy or purchased on a later date. Paid vacation and holiday leave shall be accrued for interim purposes because these are enforceable as legal commitments. Gain and loss. Gain or loss from disposal of property, gain or loss from discontinued operations, and other gain or loss shall not be allocated over the interim periods. The gain is reported in the interim period when realized, and the loss is reported in the interim period when incurred. Income tax. Interim period income tax expense shall reflect the same general principles of income tax accounting applicable to annual reporting. Paragraph 12 of Appendix B of BAS-34 states that the interim period income tax expense is accrued using the annual effective income tax rate applied to the pre-tax income of the interim period. To further explain this income tax, let me give you an illustration. An entity has the following income before tax and annual effective tax rate for the first 3 quarters of the current year. First quarter, income before tax 5 million, tax rate 30%. Second quarter, 6 million, 30%. Third quarter, 8 million, 25%, with a total income of 19 million. So, the income tax for each quarter is computed as follows. First quarter, 30% times 5 million equals 1.5 million. Second quarter, 30% times 6 million equals 1.8 million. So we use 30% for both the first quarter and second quarter because it is the tax rate applicable to the first 2 quarters. Total income tax for the first 2 quarters is 3.3 million. Now, to get the third quarter income tax expense, we need to get first the cumulative income tax for 3 quarters, which is computed by 25% multiplied to 19 million. 25% is the tax rate for third quarter, and it is used to get the cumulative income tax because it is the effective tax rate for the 3 quarters, and it is multiplied to the total income of the 3 quarters, which is 19 million. So it would result to 4,750,000. Income tax for the first 2 quarters, which we solved earlier, is 3.3 million. So we will subtract 3.3 million from 4,750,000 to get the third quarter income tax expense of 1,450,000. So what if there is a difference in the financial reporting year and the tax year? If the financial reporting year and the income tax year differ, paragraph 17 of Appendix B of PAS 34 states that the income tax expense for interim periods of that financial year is measured using the separate effective tax rate for each of the tax years applied to the portion of pre-tax income earned in each of those tax years. Simply stated, the effective tax rate of a particular tax year is applied to the pre-tax income of the interim period in the same tax year. So to clear things up, here is an illustration. An entity's financial reporting year ends June 30 and it reports quarterly. This means that the financial reporting is from July 1 of one year to June 30 of next year. The tax year ends December 31. So there is a difference between the financial year and the tax year because the financial reporting year uses fiscal year which ends June 30 and the tax year ends December 31. So here are the given. The income before tax for the financial year from July 1, 2020 to June 30, 2021 is as follows. First quarter, July 1, 2020 to September 30, 2020 is 1 million. Second quarter, October 1, 2020 to December 31, 2020 is 2 million. Third quarter, January 1, 2021 to March 31, 2021 is 2.5 million. And fourth quarter, April 1, 2021 to June 30, 2021 is 4 million. The effective income tax rate is 30% for 2020 and 25% for 2021. The income tax expense for each quarter of the financial reporting year is computed as follows. First quarter, 30% times 1 million equals 300,000, and second quarter, 30% times 2 million equals 600,000. We use 30% to get the income tax expense for the first quarter and second quarter because it starts from July 1, 2020 to December 31, 2020. Third quarter, 25% times 2.5 million is 625,000, and fourth quarter, 25% times 4 million is 1 million. We use 25% because third quarter to fourth quarter is from January 1, 2021 to June 30, 2021, which is covered by the effective income tax rate of 25% for 2021. The total income tax expense is 2,525,000 pesos. Change in accounting policy. A change in accounting policy other than one for which the transition is specified by a new standard shall be reflected by restating the financial statements of prior interim periods of the current year and the comparable interim periods of the prior financial year. So, the objective of this requirement is to ensure that a single accounting policy is applied to a particular class of transaction throughout the entire financial year. If we allow different accounting policies for the same class of transaction within a single financial year, it would result in interim allocation difficulties, obscured operating results, and complicated analysis and understandability of interim information. So that ends the part 2 of our discussion in interim financial reporting. Thank you and God bless.